Get Rich Education is brought to you by Valhalla Wealth and Ridge Lending Group.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to GRE. This is Get Rich Education, episode 177. Hi, I'm your host, Keith Weinhold. Take action. Mortgage interest rates have been on their way up, so take action as soon as you practically can. It is better for you to do something imperfectly than to do nothing flawlessly. So you can act by engaging a mortgage lender that specializes in income property loans specifically. And now that can help you if you engage a specialist. And we've talked to some here on the show. And you know, what do most mortgage loan companies do out there? And what do most realtors do, actually, for that matter? They send you refrigerator magnets and they send you newsletters with recipes on them. And then they hope that you're going to go and get a hold of them. Well, very few actually know about real estate investing, income property. So the realtor that sends you the nicest pen with the blue ink that flows the first time and every time, that's not your guy, okay? And you know what else out there? There is no official designation by the National Association of Realtors or anyone else of like an IPS designation, an investment property specialist, which is an acronym that I just totally made up right there because there is no such thing, okay? So you can either find a good, knowledgeable real estate licensee by getting a referral from a friend that's used one, or by finding out about one at your local real estate investor association, or use greturnkey.com, where you don't even have to be concerned with enlisting an agent at all. Those income properties are just already there for you when you engage providers at greturnkey.com. And I've put a lot of work into compiling that list of the best income property providers in the best real estate markets there. Well, I have just returned to the United States today after a great real estate investing due diligence trip and partial vacation too in Placencia, Belize, there in Central America. And I found some really unusually good promise there that I want to tell you about on a future show, but that's for another day. Coming up down the road, we've got the return of the most recurrent guest in Get Rich Education history. Yes, you might know who that is. The dynamic Rich Dad tax advisor, Tom Wheelwright, and I are going to tell you even more about how you, as a real estate investor, can take advantage of Trump's tax plan now that it's settling in since it was passed a few months ago. And we've got a lot of other great shows coming up here in coming weeks. But first, we've got a really good guest today. He's a really sharp guy and a trustworthy person. Now, this is a person that, okay, are you ready for this? He used to give people financial advice when he was with Dave Ramsey's group, and then he changed. He repented, by guest transformed. And it's not that Dave Ramsey is a bad guy, not at all, but his advice is just, oh, geez, it's so doggone lousy in my opinion, and I'm going to tell you why. I'm also going to ask today's guest about what made him transform. What was that turning point that changed him from a debt-free mindset guy to the financially mindset man that he is today? And you know what? I used to be a debt-free guy until I learned better, and most people never learn better at all. Yes, back when I worked for an employer, which was with the state's Department of Transportation, I used to max out my 401k. It was actually called a 403b there, and they're basically the same two things for all intents and purposes. One is basically the private sector's answer to deferring your life, and the latter is the public sector's rendition of a life deferral plan. I used to max it out because I actually used to think that was smart. Yeah, right? The power of tax deferral. Well, we're going to talk specifically today about why that is deeply flawed. One time in my life, I actually used a 15-year mortgage loan on a property instead of a 30-year loan. I used to think the 15 was smarter because I could easily point to the amount of money in interest that I saved over the 30-year loan until I started asking myself some better questions, including, what if instead of being concerned with saving money on interest, I reinvested that money at a higher rate than just getting a lower mortgage interest rate? And then when you do that, the savings on the 15-year look paltry. Even more importantly, using a 30-year loan instead of a 15-year loan definitely increases my cash flow today, which is something that really, really matters, rather than cutting lifestyle now and hoping for a better someday. A 15-year loan, that also cuts down my leverage ratio faster. That dilutes my inflation profiting benefit on the long-term fixed interest rate debt and hurts my tax advantages, and on and on and on. So today I'm talking with my guest about his transformation, the mindset around his change in investing for income. And then later we're going to get actionable and get into some of the numbers and have him talk about how mutual fund investors get seduced by old-fashioned financial advisors and sleight of hand on reporting the numbers. He's really an expert with that. Next week, it's going to be more of me talking directly with you and your real estate investing. Let's meet today's guest. Today's guest believes everyone has the God-given right to own their potential, but most of us don't, because, as he puts it, we spend 40 hours per week serving the 40-year-to-life sentence, trading our precious time for worthless paper called money, or really currency. We live on an economic planet, and time and money do need to be exchanged, but it doesn't need to be your time or your money. He teaches his clients to secure income-producing assets that make the time and money exchange for you so you can buy your freedom back and live a life of abundance and prosperity. To get there, we must know how to make money, how to keep it, and how to multiply it. He provides education, coaching, accountability, and community to help you build wealth. And, it feels like it's been a long time coming, so it's great to finally have you here. Welcome to Get Rich Education, Jerry Fetta.
Hey, Keith. Thanks for having me. I appreciate you having me on the show today. I'm excited to speak to your listeners and just kind of let them know how they can get that abundance and prosperity built out.
We're going to do just that. And Jerry, with listeners here in 188 world nations and guests from all over the place, it's so good to have you on, because we've only had a local guest on, I believe, 3 times previously. So it feels extra special to have you here. We're both in beautiful and pristine Anchorage, AK today. And what's so interesting, Jerry, is your provenance, your background, your frame of reference, where you came from. You have a background with the Dave Ramsey experience. Dave Ramsey is a financial pundit that really emphasizes that one be debt-free, which is kind of opposite from what we do here at Get Rich Education, where financially free beats debt-free. So, Jerry, just tell us a bit about your background in the Dave Ramsey experience.
Yes, so I was actually what's called an endorsed local provider for Dave Ramsey for investing, and I did that for about 2 or 3 years. And so what that looks like is I was part of the Dave Ramsey investing philosophy. If you followed Dave at all, 12% returns in mutual funds, splitting your retirement up into 4 different growth stock mutual fund categories. And so that was what I did. That was what I breathed. That was what I taught my clients. So when Dave would have people from his listeners or from his Financial Peace University or different courses he was doing, he would send those people that were interested in investing over to me. And let me tell you what, Keith, I was indoctrinated. That was 100% the way that I thought investing happened. When people talked to me about OPM and leverage and debt, I just thought that was wrong. It was the worst thing someone could do with their money was to go into debt. And really, that was evidence that at that point in time, I had absolutely zero financial education when it came to how to leverage money and how to get passive income.
Yeah, I think a lot of you are familiar with the Dave Ramsey philosophy. And, I guess I'm not going to go and call every last ounce of it absolutely wrong, although a lot of it is counter to the way I think. We're both in the financial education space. And I think Dave Ramsey, he sort of puts a safety net beneath people. He tries to prevent them from falling into poverty, but those people never then elevate to their best and highest use. So here at Get Rich Education, we cultivate prosperity, and it's really more of an elevation. And I'd characterize more of the Dave Ramsey experience. Jerry, feel free to chime in. But, he has said in the past, I don't know if he said it lately, but he sure has said often, you need to live below your means so badly that you literally need to eat beans and rice. You need to eat cup-o noodles, ramen noodles, until you have your car paid off, for example. Well, here at Get Rich Education, the interest rate on your car loan, if that's lower than the rate of inflation, why don't you slowly pay that off over time? Don't rush to pay down the debt, and instead build up your income or learn how to invest. You can probably arbitrage that paltry interest rate that you have on your car that inflation is eroding away. And it really comes down to what kind of life are you really designing for yourself? And it's just not as simple as saying that debt is always bad.
You're exactly right, Keith. And the thing that is not taken into consideration is some things are not worth owning. So, for example, if you took a vehicle and you paid cash for a vehicle like Dave talks about, you put $10,000 into that vehicle. Well, the only thing I can guarantee is going to happen is your $10,000 is going to turn into $6,000 over a course of 3 years. So if you average that out as a rate of return, owning a car is a negative rate of return. It's a liability. So there's no reason why someone would want to own that vehicle when they can actually finance that vehicle and use month-to-month cash flow to pay for it. And in a best-case scenario, maybe even secure an asset that makes that payment for them.
Oh, yeah, there's just so much to touch on there. And that mantra and this mindset can be extrapolated out into real estate investing and other parts of life. It's about comparing employment cost with opportunity cost. Okay, so the person that paid all cash for a car, $10,000, yes, they can point to a number and say, I did save this much in interest. See, that part's visible. What's invisible is the greater investment gain that person missed out on by locking up money in a car. Wow, like that's really a smart investment. 100% equity in a non-cash flowing internal combustion engine with 4 wheels. Really. So that is not an abundant mindset. Come on, let's expand, not contract. Let's produce, not reduce.
And that's very true. With that whole mindset, it's very based on scarcity and it's very based on worst case scenario. And so I teach my clients what you think about grows. And so if you go into real estate and you think about, well, what if I can't pay the debt? What if the property doesn't cash flow? There's really 2 things there. A, you should know that stuff before you get into it. And B, if that's all you think about and that's all you focus on, that's probably what's going to happen. And so if you go into investing and wealth and finances thinking I'm going to increase my income, I'm going to make good decisions, I'm going to get educated, and that's where your mind is, I don't think you need to worry about all of the other stuff. And really kind of Dave's background story that I learned later on is that he made bad decisions in real estate that caused him to over leverage and get into properties that didn't cash flow.
Right.
So his whole philosophy is based on his own bad experience, his own lack of research, and his own mistakes. And so putting those subjectively onto others really isn't the right way to do it.
Yeah, I think it's just so simple, and it's so much easier for people to stay affirmed and say something like retire debt at all costs. But when you're informed instead of affirmed, now you need to change. Now you need to do some thinking. Now you need to take some action. Dave Ramsey, he keeps people in their comfort zone, and that's exactly why he's popular. Affirmation is a comfort zone. Get informed rather than affirmed. Affirmation, that means it's all these things that you learned from childhood. Always live below your means. Debt is bad. Money is scarce and it doesn't grow on trees. It's easier to be affirmed in those old-fashioned limiting notions rather than to be informed. Informed rather than affirmed, that says, come on, leave your comfort zone and grow up, have more. When you're informed instead of affirmed, you can live better and give better to others than you ever thought was possible.
Yeah, and that's very true. It's things that our parents taught us. Dave actually does say in many of his different courses, and you apply it to 2018, it's just not going to work.
Yeah, exactly. Your grandma was alive when people had a pension. Your grandma was alive when people used the gold standard. Well, you've got to discuss what works in today's economy. And Jerry, I want to ask you more about your personal transformation. So you were in the Dave Ramsey program. You even used the word indoctrinated. But at that same time, you're hearing echoes from elsewhere. Maybe you're hearing things like, you know what, leverage beats compound interest all day. Maybe you're hearing, don't use your money, use other people's money. That's what creates wealth. So just talk about that personal turning point away from that for you.
Yeah, it was kind of a buildup. So my story with this actually goes back to when I was about 13 years old. I have a friend that I grew up with, and from about the age of 13, I would go to their house, and his dad, I would see him at home at weird times of day, and I understood employment. So I understood that if you work a job and you're 9 to 5, well, it doesn't make sense for you to be home at 2:30 in the afternoon. And I never understood what his dad did. And so as I got older, I read a couple of different articles. I actually listened to some of Keith Weinhold's stuff here. And so my mindset got into basically that questioning mode. What else is out there? What else is really going on? So I sat down with my friend's dad and I asked him, what is it that you actually do? Because you don't work. They were very well off. They had new vehicles. They had a nice house, all of these things that evidenced that they had income and they had assets. But I didn't see where he was trading his time for money. And so what he told me was, I use other people's money and I use passive income, and I do that from investments. And so because of that, he can wake up and have income rolling in whether he decides to work or not. And when I ran the math on this, and we can kind of dive into this in a little bit further in depth, Keith, but there's really two ways to invest. There's the way that he was doing it where you secure an asset and the asset pays you income. And because of that income, you don't have a reason to get rid of that asset. Or you can purchase a bunch of things and hope they go up in value. And when they go up in value, you can sell those things off and hope that you don't run out of money when you sell. And so this individual, he was choosing to buy those assets and let the income produce rather than try and trade time for money and build up that, if you want to call it a nest egg, and then hope that that nest egg lasted him the rest of his life.
That is so valuable that you were exposed to that and you had that frame of reference, and that's a rare thing. Yeah, and the inverse of that, and what's more common, is the person that never learned how to use their money well and use other people's money well to work for them. They didn't employ those tools to work for them, so then they had to work themselves. So the guy that's finally debt-free at age 56, he really didn't win at all because he worked overtime at the lug nut factory instead of using leverage and arbitrage throughout his life. So now that he has time, finally, at age 56, his kids are grown and gone. He's got a bad back, and he finally can start living, quote unquote, at age 56, debt free. Well, that guy did not win at his financial life, and at much of his life, he failed to fulfill his potential. He failed to give his family his time when they were being raised. He failed to produce enough to give well to others or to live well himself, and he spent much of his life as a reducer, not a producer, and as a soulless grinder.
That's true. And the average retirement, when you actually look at the numbers, the average client that I talk to, they're running out of retirement income within 10 years. And so they've been still taught the story of, contribute to the 401k, work at the same company for 40 years. It's a lot of that old school gold standard pension thinking. But if you look at the math, these people are getting to retirement and they're not making it. Just look at the baby boomer generation. Statistics don't lie. And so you can see that people are getting there. They don't have enough assets saved. They have a primary residence that's probably 2/3 or more of their total net worth, and the income just isn't there.
You know what I think, Jerry? Most Americans, Canadians, and others, they just still don't correlate cause and effect here. Okay, stocks, bonds, mutual funds, and ETFs invested inside vehicles like 401ks and IRAs, they usually end up creating disappointment and maybe even danger for people. Just the other day, I was on a plane. I was on a flight, and I got up to stretch my legs, and I was walking around. And as I was walking by, I overheard just about 10 seconds of a conversation between a father and his daughter that was maybe, 11 years old. And the dad was just quipping and saying something like, remember, this is what I showed you before. These are stocks here that he was looking at on his phone. He was saying that, remember, that's a really good thing to invest in when you're older. And this is just a pretty good dad, probably just giving what he thinks is prudent advice to his 11-year-old daughter. But people just don't correlate these things. Oh, gosh, I was tempted to jump in on that conversation, but I didn't. And the outcome is that those vehicles basically end up giving you a woefully inadequate outcome. People just still are not correlating this cause and effect.
Yeah, and the outcome is really what you need to start with. I come from a perspective with my clients of you have to look at the result. We have to realize if our result is not where we want it to be at, then the actions, the thinking, and the mindset which has been causing that result can no longer be the operating basis. It has to be considered invalid. And the other thing to realize too is that the mutual fund idea, the 401k idea, it's highly propagated. It's been pushed out there by media, by financial firms, by Wall Street, by the IRS. The fact that the IRS supports it, that alone should tell somebody it's a bad idea. I mean, really, if you look at the 401k, it came to place in, I think, in the late 1970s. So it's not even as old as my dad is. We're not seeing a full generation utilize that system successfully, yet somehow it's the status quo of how to get to financial independence.
Well, yeah, and the 401k, the way it's used today is not the way it was originally intended to be used. In fact, Ted Benna, the father of the 401k himself, he called the plan a monster. He knows that it's inadequate. But Jerry, let's get down and really specific about something, and that's just the way that the rate of return numbers are reported to investors when they're invested in things like mutual funds. And these investors or speculators, really, they're kind of being deceived. And it's really eye-opening to people. And you're really an expert at breaking down the way that the numbers are reported. So tell us about that.
Yeah, that's actually a great conversation to have. Most people don't realize this information, I would say, ever. And so when I sit down and go through this math with them, it's the first time that they're realizing they're not dealing with honest people. The industry behind this, their job is to sell product. And so when they put out a rate of return, when Wall Street says, hey, you earned this or you could earn this, they're showing you the best possible scenario, the best thing that they could show you from a standpoint of getting their marketing into your hands so that you're attracted to their product and you buy more of it. So just to give you a practical example, Keith, if you're looking at a mutual fund statement, and let's say that you're invested over the course of 10 years. Now, over 10 years, let's say your money went up 10%. Okay, so your 10 years, 10% on your dollar. If you do the math on that, you can average the return out and say, well, Keith, you made 1% on average per year. A 10% return over a 10-year period. If you divide 10 by 10, well, that's 1. Well, the reality is that doesn't take into effect compounding. And so a mutual fund doesn't have to utilize what's called a compounding annual growth rate. Instead, they can use what's called an average annual return. Now, that average annual return, that was the 10% divided by 10 years. In reality, if you factor in compounding, the number is going to be lower than 1%. And so if you just do a simple calculation on compounding growth, you can put into an investment calculator that you bought it at $1 and you sold it at $10. And if you did that over a 10-year period and you figured out what was your actual compounding annual growth rate over that 10-year period, it's going to show you that it's a lot less than 1%. And so when you pull that number up on a mutual fund statement, you can't find it. You actually have to go into an investment calculator. It's going to come out to much lower than 1%, and you've got to figure those numbers out for yourself. Your advisor's not showing that. Now, the other thing is the mutual fund has what's called a statement of additional information. Now, the statement of additional information is all of the different fees that should have been told to you when you purchased the mutual fund, but instead, because they're not attractive, you're given the responsibility to go read about those fees on your own. Your advisor doesn't actually have to go through those with you. If you're talking to a Wall Street broker, they'll say, well, Keith, you can earn a 12% return. In reality, it might only be an 8% return because they haven't told you about A, it's a compounding annual growth rate. And then B, you have different fees that are being subtracted for things like low account balances. Management costs are a very big one. Most people don't realize that a 1% management fee annually on a mutual fund portfolio over the course of a 3 or 4 decade period, that's actually taking up oftentimes 25 to 30% of the total portfolio value. So you really have to ask, what is this thing worth? Is the advice I'm getting, is the help I'm getting worth? If it's $1 million, you're paying 30%, that's $300,000.
Yes, that has a compounding deleterious effect.
Yeah, and it really does get out of control because it's not a check. Because it's not a check that you're paying, you don't see it. It's a lot like taxes. So it's almost insidious in a sense. It just comes right out. You meet with that person once a year, they read your statement to you and they say, well, it looks like we made money, or well, it looks like we lost money, but let's hang on for the long term. And you never realize how much you're actually paying in dollars. And that's one very big thing that I want investors to understand is you don't get paid in percentages, you get paid in dollars. And so if you can't convert it into dollars and look at, well, what am I making in dollars and what am I paying in dollars? It's great to look at percentage, but you can't go to the Costco and say, hey, here's my groceries. I want to give you 8%.
Right.
It's a $300 grocery bill.
We're talking about how mutual fund ROIs are reported with my good friend Jerry Fetta. We specifically addressed the compounding annual growth rate, CAGR, versus the annual average return and just how that can be manipulated. Anything else that you can ask your financial advisor that's really specific, Jerry?
Yes. So the biggest one is when you sit down and you look at the initial statement, you need to be looking at the compounding annual growth rate. In reality, it's not going to be on the average mutual fund statement. So when you're sitting down with your mutual fund broker, your financial advisor, I want you to ask them, is this the average annual return that I'm looking at, or is this the compounding annual growth rate? Now, the mutual fund advisor is probably going to acknowledge the compounding annual growth rate as what's called an annualized return. It's just different vocabulary for the same thing, but that's the real number that you want. And if you can't get that number from the person, it shows that it's probably not an investment that you want to get into. And it also shows that the level of competency with that individual probably isn't there at the level that you would want to give them your financial future, which is a totally different story, giving your future to somebody else. But that alone, that they might not know the fee structure, that's an indicator to you to take your money and run.
Yeah, Jerry, just last week I was talking about how stock investors think they're getting ahead, but they're not. So we're talking about maybe they get a 10% nominal annual return, however they calculate it, minus 5% for inflation, minus 2% for fees, minus the volatility component, minus the taxes. Even if it's tax deferred, there are taxes. And there's that emotional predisposition to buy and sell at the wrong time, that emotional component that you just can't discount. With these equities that are so easily liquid, people often sell on a panic emotion. Well, it's tougher to panic sell in something less liquid and stable like hard assets. And I really stand by that 5% inflation, the true diminished purchasing power of the dollar that you've got to account for. The inflation is reported by the BLS, the Bureau of Labor Statistics. Well, the BLS, they report that 2% inflation number lower than it really is. Come on, the BLS, this is the same agency that reports the unemployment rate artificially low at about 4% right now. And I don't think that anyone believes that. And they manipulate the CPI, the inflation number, in the same way. So there's just so many reasons that stock investors aren't getting ahead. Oftentimes, they're really sliding back.
Yeah, and really, Keith, what people aren't realizing in addition to all of those things, and that's a list of things, right? If you were looking at an income property, I would say that there's a very small list of things compared to what you just named off with mutual funds as far as hidden gotchas. But people also don't realize when you do the retirement thing with the 401k and the IRA, you're agreeing to a series of different terms, and it's going to dictate the way that you live your life. And so the first thing you're agreeing to is waiting till you're 60. I talk to clients a lot and I talk to them about, hey, when do you want to retire? And it's almost just automated. They blurt out like a robot, 60. And it's just because that's what everyone does. And I have to ask a second time, no, if it was up to you, when would you want to retire? And they never still say 60. They say, oh, I want to do 55 or 50 or 45. rate of returns and fees aside, that component alone makes the 401k invalid because your 401k will not let you access it till 59 and a half unless you want to pay a 10% penalty in addition to the taxes and fees that you're already paying. So that's the first thing to look at. The second thing to look at is tax deferral is one of the biggest scams in the world. And this is not taught. We're taught that you can defer your taxes, and that's a good thing. Now, if you look at taxes now, historically, and Keith, I've seen you post one of the best infographics on this I've ever seen, but taxes now versus taxes a century ago, it's astronomical.
Right. I know the chart.
And so the concept that I'm going to put in $100,000 in today's money, and I'm going to wait 40 years. Well, in 40 years, that 100,000 will grow to a bigger amount. And in 40 years, that bigger amount is going to get taxed at income tax bracket rather than capital gains tax bracket. If I would have held that money outside of a 401k, it would be considered a long-term capital gain, and I'm probably only paying 15% on that capital gain. But because it's a 401k, now it has to be income. If I'm wealthy, then the likelihood goes up that I'm in a 30, a 35, or maybe even a 40% tax bracket with my income. And then in addition to that, income tax will be more in 40 years than it is today. It's just simple math and projection. So that's the other series of things to consider with a 401k is, does this thing create the lifestyle that I want to build? You know, if I want to retire early, I probably can't do the 401k. If I want to actually save in taxes, I probably should consider not doing the 401k.
Oh, yeah, there's just so much great stuff to touch on there. That client that's in your office, when you ask them when they want to retire and they say something like age 60, that right there is the result of programming. It's probably the programming where in their mind they know that with a 401k, you cannot take non-penalized distributions from that 401k until between age 59 and a half and age 70 and a half. That's when you must begin taking distributions. And that's also when you must begin paying taxes on it. And some people say, oh, well, that's okay. At least I'll be in a lower tax bracket then when my income's lower. No, that's wrong. Your income should be higher in retirement. You should be building up cash flowing assets throughout your life. Therefore, you should be in a higher tax bracket, and you're not going to have to pay tax on that anyway to nearly the extent that you are with other vehicles because you're in something like real estate. So this is a difference between planning for retirement relative poverty and planning for prosperity. We're talking with my friend Jerry. He's an expert at helping you build your income with cash flowing assets, and he's also an expert at helping you keep score with learning what your returns from stocks, bonds, mutual funds, and ETFs really are. We're going to have more when we come back. I'm your host, Keith Weinhold. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president and chief wealth strategist of Valhalla Wealth. They help busy people build wealth outside of Wall Street by strategically combining their clients' cash flow statements with the financial vehicle of the wealthy, according to the infinite banking concept. If you are interested to learn how to perpetually multiply your wealth, you can access an exclusive webinar at yourownbankingsystem.com. Cash flow real estate investors, if you're looking for a mortgage loan with a company that specializes in investment property loans, it's Ridge Lending Group. They provide income property loans in almost every U.S. state. Ridge has worked with tens of thousands of investors and homeowners all over the country. In fact, with ethics and transparency, they've helped more people realize their dreams through real estate investing than any other mortgage lender in the country. Get started at ridgelendinggroup.com.
This is Peak Prosperity's Chris Martinson. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with my friend Jerry Fetta. We're talking about the importance of investing for income. We're really keying in on how stock and mutual fund ROIs are calculated, how they're often manipulated. And Jerry, I want to ask you about something that I think I'm going to find really interesting. Just talk more about a typical client that you have there at your business and how you've helped them.
Yeah, definitely. And Keith, I'll do you one better. I have an actual case file in front of me. We'll call this person Bill, and I'll just kind of talk you through the scenario that Bill had when he came to me, what we looked at as far as what his retirement was going to be if he did not make any changes. And then also we'll look at, once we did rearrange things and make some shifts in investments, what this projected out to and what Bill is going to be making now. So initially, Bill had $118,000 in 2 different IRAs and a 401k. So combined balance of about $118,000.
Okay.
Bill is putting $916 per month into this. So he's contributing regularly. And when he puts that $916 per month into his account, mutual funds have what's called a front end load. And so what that is it's a commission that an investor will pay up front to have the right to purchase the mutual fund. Now, I don't want to bunny trail too hard on this, Keith, but I want to just give you a hypothetical investment proposal. Let me know if you would do this deal with me, okay?
Okay.
All right. So I'm going to borrow your money. And to borrow your money, you're actually going to pay me a 3% fee on every dollar that I borrow from you.
I'm already not liking it.
Already not liking it? Well, there's more, so don't quit on this yet. It might get better. In addition to that, when I'm borrowing your money, you're actually going to pay me the interest. And so I'm going to charge you 1.25% interest per year for the privilege of letting me speculate with your money. Now, if I go and speculate with your money, I'm going to buy invisible shares that show up on a computer screen. They're backed by a piece of paper, but I can't actually do anything with them. It's just invisible. I'm going to give it to one of the most dishonest groups of people in our country, and we're going to hope that they make money. Now, if they make money, I'm going to pay you everything over the interest that I'm charging you to borrow your money. If they don't make money and they actually lose your money, I don't have to give you anything, but you still have to pay me the interest every year. Do we have a deal?
Yeah, I don't even know if we have a friendship anymore after that.
So that's kind of the premise. Now, with this particular case with Bill, he put in $118,916. He did this for 10 years. He paid $3,298 in total front-end load fees. That's that 3% commission Bill paid. Now, over this course of time, the S&P 500, the index, only did an 8.26% annualized return. Now, when he is paying that 1.25% management fee that we talked about, he's really only netting an effective return of about 7.01% per year with that fee subtracted. Now, his balance in 10 years would grow to $382,000. And if he sold that balance for income, meaning that he distributed his shares, Bill would run out of money the very first year of retirement because Bill wants to live on about $30,000 per month. Now, if we just talk dividends, dividends are what supposedly the share is going to produce if we don't sell. Bill is going to make about $308 per month in dividends if he decides not to sell his shares. So Bill is faced with either running out of money the first year retirement or trying to pay the bills with $308 per month during retirement. So that's what Bill was looking at. Total collective fees he was going to pay over 10 years. It came out to about $56,000 just on a 10-year period. Now, with the shift we made, we basically just looked at, well, what if Bill did real estate? And so we looked at some real estate-backed investments. They were paying a 10% interest rate. That's annual cash flow. So a 10% yield, if you want to call it that.
Okay.
Over that same 10-year period, Bill was going to earn $467,000 as his final balance, as opposed to $382,000. Now, that's just the balance. If it's a good investment, the balance doesn't matter because Bill wouldn't sell it. Bill would keep it. It's about the cash flow. So because this thing produced cash flow, this new investment strategy for Bill, it was going to produce $3,893 per month without doing anything different other than just changing where he puts the same money. That's pretty much a 10x return, $3,893 per month, as opposed to $308 per month.
Yes, I'm sure Bill's head was spinning after that.
Yes, and people don't realize this until they actually sit down and do the math.
Now, you're talking to clients that are everyday people, family women, family men, and, a lot of people, they just don't even know about passive income. So is that alone explaining to a person that they can produce income that they don't have to work for? Is that a revelation or an epiphany to people, or do they even have some disbelief about passive income ever?
That's very common, actually. I talk to a lot of people where, their impression is that passive income is that thing that you see on the late night TV commercials and it's not obtainable. Oftentimes when I sit down with clients and I talk goals, Goals are even foreign, because when you think about, if currency is just an arbitrary green piece of paper and it isn't backed by anything, it just happens to be the medium of exchange that our economy will accept. And so when somebody thinks goals, they're really needing to think about, passive income is going to buy time. And really, what then am I doing with my time? And so when we come up with that passive income number, oftentimes I hear the question, is that what other people are doing? Is that realistic? And so what that's saying is people really don't believe that passive income is a real thing. They're asking the question, is this a reality? Can it actually happen? Does it actually happen? And what does it look like when it happens for other people? So yes, it's a totally foreign concept.
And besides being a foreign concept, passive income is counter to the Dave Ramsey, the affirmation, the old-fashioned thing, which is more about a hope for a capital gain. So what else do you tell people about income?
Yeah, that's a great question, Keith. The first thing that I have people look at is the concept of currency devaluation. Everybody that I've talked to that has bought into the Dave Ramsey system, bought into the traditional, and we shouldn't even be calling this traditional because we just talked about it. It's less than 50 years old. The concept of, put money into the 401k and defer. Taxes are not the only thing that these people are deferring. They're deferring their life. And so they've been taught, I need to learn so that hopefully someday I can work, so that hopefully someday I can play. And so the beginning conversation with people really starts with, well, do you really want to wait that long to play? And do you really want to have to work for that long? And if you could play sooner, how much sooner would you? And what things would you do? Where would you spend your time? Who would you be with? What would you do? Where would you go? And so it's reactivating a lot of the imagination, the desires, the dreams, and the passions that people have really quit on just because A, they've been told it's not realistic, and B, when they look at the numbers, it just simply doesn't add up. So beginning conversations with people really have to go back to, what do you like to do? What would you like to do? If you have 168 hours per week, where do you want to spend that? Sure, you'll sleep for 56 of them. But after that, if you're not working at a full-time job and you have full control over your time, what are you going to do with it? And that really is the inspiring conversation that starts to get people to dream again. And once we can dream, then we can start thinking about, all right, income. Now, if we're thinking about income, like you said, the biggest thing is we want to make sure that we surpass cost of living, we surpass taxes, we surpass inflation, and that somebody's not running out of money. Because if you get to that point in life where you're living out your dreams, the worst thing that could happen is you have to go back to work. And that really comes down to, you can buy things that go up in value and sell them over time and hope you don't run out, or you can buy things that produce income and just continue to live off of the passive income produced.
I love it. I know I've said it on this show before. Ostensibly, the tax deferral plan is actually a life deferral plan. Why don't you go ahead and grab a hold of this and just re-engineer your life and quit deferring it?
That's exactly true. And when I first started, when I did the Dave Ramsey stuff, I was taught that when somebody retires, they only need 60 to 80% of their working income.
Right.
And really, like you said, what was the last 40 years for? If you were going to do 40 years of work at a job you hate, trading time for money, there better be a payoff at the end. And with that plan, there's not a payoff at the end. Life actually goes down. Your standard of living actually drops for all of that work you put in.
A lot of people show up to a job that they don't like, and they really do it out of fear. And I think something that person tells themselves is maybe someday. They're just relying on that. Life can be better than pinning your hopes on maybe someday. Come on.
I agree. So, conceptually, what it starts with is people need to realize that the current system doesn't work. And that's really where the conversation begins. And numbers don't lie on that. You and I have talked about, you have to look at the cause that you're trying to create. And basically, if that's not working mathematically, you have to go back to the root of it and change that. And that's why passive income producing investments really are the only way to go.
Now, Jerry, I think Dave Ramsey, he's a guy that actually has quite a bit of ethics and integrity. But you know what? It took ethics and integrity inside of you, yourself, to basically go ahead and uproot your way of thinking and uproot how you operate and get out of that school where you and you're having your clients pay fees to mutual fund companies, and you change your philosophy, you change your model, you change who you associate with, because you know you're doing more good in the world when you're showing people the income-centric way to investing, which is really what investing is.
Yeah, and the thing that I learned from that transition is that there really is not a clear path. When somebody decides, I want to do different things with my investments, maybe in the alternative space, maybe in the real estate space, because there aren't these large financial firms out there touting products and services in that realm, it really is like a jungle. Someone has to go out and blaze their own trail. And so that's really the thing that I went through, was blazing that trail and finding out, well, where does somebody go? What can somebody do? And from an advisor or a coaching perspective, how can I give better advice and better planning so that somebody doesn't have to go blaze the trail? There's already a system they can plug into. And it's a system that they don't have to pay hundreds of thousands in fees for. It's a system where they're not buying invisible investments and hoping that those things go up in value. And it's a system where they have control. They can actually see a tangible asset. They know what it's going to do. It's paying every month. And that's what's really the value add on this, is when somebody is going through that process, generally speaking, if they had to go find it out for themselves, they might quit, the work entailed. And so that's why it's so important to have podcasts like yours, different resources that are giving information on the direction somebody can take.
Jerry, any last thing on both the philosophies or the actions that one can take in investing in an income-centric way? Maybe something that I did not think of asking you about?
The final thing that I would add to this is really look at what you're doing with your money today. People don't realize how easy it really is to get started. And part of that is, again, the propaganda of investing is hard. And I have to say that if you learn the basics, there are certain premises of good investing and poor investing. If you learn those basics, investing becomes very easy. So I would say, basics, if it doesn't cash flow, don't buy it. If you can't look at an income statement and see that it gives you profit every month, it's probably not a good investment. Another one that I have is, if you can't touch it, probably don't buy it. If you don't understand it, probably don't invest in it. So those are three very easy, basic things. Make sure it's cash flowing, make sure that it's real, it's backed by something that's producing the income, and make sure it's something you do understand.
Jerry, for years, I've had people ask me to coach them one-on-one, and I'm just really not set up to do that, to go ahead and tell people how they can produce an income, customize a plan, and even break down the numbers on their stock and mutual fund type of investments to show them the real return that they're getting. And besides really not being set up to do that and not having the time to do that in my life, for years, I really didn't know of a competent, trusted person that could go ahead and provide some coaching in an income-centric way until I met you. So tell our listeners how they can engage with you to just go ahead and find out if it might be a good fit, and they can get some one-on-one coaching on a program tailored specifically to them and their needs.
Yeah, so I will work with clients on a one-on-one basis with a lot of the things we talked about today. And so if somebody is listening to this today and you're saying, man, this is the path I wanted to go on, I just haven't known who to talk to or where to get started, you can go to Keith's website, getricheducation.com/coaching. You can fill out a request. We'll do an absolutely free initial coaching call and go over your goals, your dreams, and find out exactly what it is you're out to accomplish. And from there, we can create a tailored mathematical written plan that if you follow and execute, I tell my clients that I'm giving them the right answers. If they show up, they put the work in, and they listen and learn, it's inevitable that success will happen on the back end.
Well, Jerry, it's so good to finally have you here on the show with me. I can't believe it took until as long as today to do this, but I'm glad you've finally been here. Thanks so much for providing value here at Get Rich Education.
It's been my pleasure. Thank you, Keith.
Before you head off to wrestle that debt monster again, it might be worth it, but it's often not. You've got to ask yourself, for who, for what? Many are not living their dreams because they're living their fears. So I am really beyond excited to finally have an ethical wealth coach like Jerry on the show. It's the first time we've ever done that here. and he is a friend. The four of us, Jerry and our wives, we have dinner together. Jerry and I have exercised at the gym together a couple times recently. You know, he's already helped Get Rich Education listeners for the past several months. It's those of you that have found the coaching page there at getricheducation.com. It's those of you that have already done that. And Jerry has gotten some rather rave reviews from you since then. If you want to get started there yourself and get a one-on-one checkup with respect to your personal specific situation and increasing your income, you should get priority treatment when you indicate your interest there at getricheducation.com/coaching. That's where we prefer that you go. Thanks for being here, but you weren't here for me. You were here for you. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Ranked by Forbes as one of the fastest growing cities, Orlando, Florida has a big and diverse economy, yet still features affordable rental properties that cash flow. Our boots on the ground turnkey provider, Greg Bond, wrote a special report to help you discover the amazing market of Orlando. Request your free copy today. Visit getricheducation.com/Orlando. That's getricheducation.com/Orlando.
The preceding program was brought to you by your home for wealth building, getricheducation.com.